Hi, my name is Ram Dhamija. Welcome to my channel. I am a full-time derivatives trader, investor, and a mutual fund distributor. I have been trading my derivatives book for the last 5 years as a professional. I have been consistently profitable, and I've been an investor for long. I invest in mutual funds and the markets, and I'm a mutual fund distributor as well, wherein I help people build very strong, robust mutual fund portfolios. So if anyone is interested in exploring making a good mutual fund portfolio or even evaluating your existing mutual fund portfolio, they can fill up a Google form which is there in the description box. So today's video is going to be slightly different. Usually I do videos which talk about the markets, the derivatives, the daily movements, and how I see the next week going ahead. So today's video is not about that. Today's video is going to be about investing. Where are the market valuations? How are they stacked up? How are the various indices stacked up against each other? Whether it's a good time to buy or not, what does historical data tell us? So all these inputs I'm going to share with you today, and hopefully you will find it useful in analyzing the market. So I'm doing it at a broad level. I'm not doing it at a stock level. I'm going to do it at an index level. So 3 indices we are going to discover today: Nifty 50, Nifty Midcap 150, and Nifty Smallcap 250. So these 3 indices we are going to analyze, and it should give you a good idea where the valuations are currently and where the pockets of value are, and how can you take advantage of investing, where you should be investing. That is the most important thing, because the relative valuations also play a critical role, and historical data plays an equally important role in deciding how you should go about your investment. So let's begin today's video. It's going to be interesting and hope you like it. So I will start off first with Nifty 50. This is the biggest index that we have. Okay, the launch date was 1996, and as you can see in the fact sheet, Nifty is made up of 37% is weightage of financials, followed by 10% in IT, oil and gas, which is basically Reliance, is 9%, autos 7, FMCG 6, and then there are the smaller one. And if you look at the current price return for this index, last quarter it has given -3, YTD is +4. Last 1 year, this is the most important one, it is basically flat, slightly negative. Last 5 years it has given a 17% return. Now why is it 17%? Because this is from the COVID lows, right? So Nifty has given a very good 17% return in spite of last 1 year being flat. So that is something which is very interesting to see, and since inception it has given a return of 11.39%. so that's why when we say that Indian markets give anywhere between 11 to 12% returns, this is what we mean. Standard deviation of Nifty is about 13% in 1 year and 15% in 5 years. So that is the kind of movement that you can expect in Nifty every year. If you look at the fundamentals of Nifty, so it is quoting at a 22 PE, 21.93, which is not less, a price to book of 3.38, which is not less again, and a yield of 1.38. The top constituents of Nifty are HDFC, ICICI, Reliance Industries, and Infosys. So this is the basic construct of Nifty, which I'm sure all of you are aware of. Now let us look at how Nifty's performance has been over the last 1 month, which is negative -3%, 6 months +4%, 1 year flat as we have discussed, 5 years 115%, and that is because of COVID. So this is how the Nifty movement has been over the last 5 years. Now let us look at how the fundamentals of Nifty are. Now let us look at the PE ratio of Nifty over the last 10 years. Now if you see over the last 10 years, the average Nifty PE ratio is about 21.9, and we are pretty much at that level only, right? So it's not that Nifty is overvalued at this point in time. Now if you look at the last 3 years, okay, you will see that again it is pretty much the same. It's at 22, the Nifty median index, which is basically the last 3 years data. So PE wise, Nifty is not very expensive right now. It is at the long term fair value. However, is it very inexpensive? The answer is absolutely no, because if you look at, there have been periods when it has gone below 20, like for example in June 22, when the last bottom was made in Nifty, or the COVID bottom, it bottomed at somewhere around 19. But if you look at the earlier times, then Nifty used to bottom around 15, 16. You can see over here in August 13 it bottomed around 15, and during the GFC, the great financial crisis, it actually went to as close to 12. In fact, even at some point in time it would have gone below that. Yeah, October, when the Lehman crash happened, it went to 10. So Nifty right now, for the last 7 years, I would say, has been making a bottom at 1920. So it's not that we are very aggressively valued right now in terms of the PE ratio for Nifty. Now let us look at the price to book for Nifty. Now price to book will vary depending on the kind of companies that are there. Because the new age companies are much more valued in terms of price to book compared to the old economy companies, which have huge plant machinery, etc. So with the introduction of new companies, the Nifty price to book has gone up a bit, and right now it is trading at about 3.7, which has been kind of been the average or the mean for a long period of time. But as you can see that whenever Nifty price to book falls below 3, if it falls to somewhere around 2.5, that is a very, very attractive time for you to look at this particular index. So right now the price to book is close to 3.5, which is neither too elevated nor too less. So another interesting thing that we should look at is the rolling returns of Nifty. So for a very short period of time, whenever the markets actually go into negative rolling return, or a flat rolling return, that is a good time for you to get a very good bargain buy, and this is a 3-year rolling. Now if you look at the 3-year rolling right now, we are at about 15.7%, which is the kind of somewhere near the long-term average. It is not very high as we had reached in 23 odd because of the elevated valuations, but we are not even less. Now let us look at the 1-year rolling also, and you will see that 1-year rolling returns are absolutely fine. So for last 1 year, because we haven't done too much and we have been flat in the market, it is actually at a flattish level, so which is actually not indicating that the market is not very expensive for Nifty. However, when you see that the rolling returns go negative for last 1 year, that is also a very good time to enter. So for example, be it 2020, 2016, 2011, 2008-9, so these are times which come once in 3-4 years, or 2020 was another such time. So we are right now getting into that territory, which can be a good value buying zone just basis the 1-year return. However, 3-year rolling returns for Nifty, as we have seen, are at pretty much the fair value. So if you ask me in terms of my assessment for Nifty, it is neither too highly valued, neither it is very inexpensive. It is somewhere in the middle right now. So if you're invested in Nifty, you can continue to do that, try to accumulate it on falls. One very good thing working for Nifty is the last 1 year returns have been flat to negative. Whenever that happens, the forward returns can be very good, because we've already seen that we have gone through a time correction, and compare it to 1 year back, when the valuations were high. So at least if the corporate India, if it has grown by 7-8% on an aggregate of the last 1 year, you are getting the valuations at least 7-8-10% cheaper than last year. And also another parameter that you can look at is how much has it fallen from the all-time high. So Nifty is already down about 6-7% from the all-time high it made in September 24. So in my opinion, Nifty is at a decent level for investment. It is not very expensive, not very cheap, and last 1 year correction in Nifty has given a good opportunity for entry. So that will be my analysis on that. And just a disclaimer over here, this is not a buy or sell recommendation. Please consult your financial advisor for this, and I'm just here presenting my views, but this is my analysis, what I feel. Now let us look at Nifty Midcap 150. Now how has Nifty Midcap 150 performed? Over here you will see that it has been very different from Nifty in terms of performance. Whereas last 3 months has given 6.8% return, last 1 year it has been flat, but last 5 years it has given 231% return. That is also because midcaps had completely collapsed during the COVID period, and now they are up at 231, which is huge return. That's almost 40% return year on year over the last 5 years. And if you look at the 3-year rolling return for Nifty Midcap, again you are seeing 25% rolling return for 3 years. It's huge, it's humongous, right? And only time when it went negative was in 2020. So midcaps, in my opinion, are slightly elevated right now. And even if you look at the Nifty Midcap, I'll just open the chart over here for Nifty Midcap as well. You will see that it is valued slightly expensive to what it has been in the past. So if you look at the P ratio of Nifty 150, you will see that we are at an elevated level of 34 PE right now, whereas the median PE has been lesser than that. It's been closer to about 28, 29, right? So which basically is indicating that there is some sort of froth in mid caps. If you look at the price to book, again it's at 3.6 right now. It has come down. It was 5.9 in October 24, which is extremely high, but now also it is not less. It is actually, yeah, it is still closer to 4.8, sorry. So it is still closer to 4.8. It's not less. It had gone to almost 6 and it is now even closer to 5. So this is very elevated valuations for mid cap in my opinion. And if you look at the dividend yield is 0.9, which is again not high. So mid cap is definitely very expensive right now as we speak. This is a very interesting chart that I would like you to look. This is the mid cap 150 versus Nifty plotting. So we see that whenever this chart it goes lower, it basically means that mid cap is valued lesser than Nifty in terms of the growth. But over here, as you can see, this chart is very high at 0.85, which basically means that this ratio of mid cap to Nifty has been steadily increasing from 22. As you can see, in 22 this ratio was 0.65. Now this ratio is nearing at all-time high at 0.85. It had actually made a peak in December 24 at 0.9, but after that we saw the correction that came in April, and now it is still high, elevated at 0.85. So in my opinion, mid caps are still very expensive on all the parameters that you look at. Now let us look at Nifty small cap and see how Nifty small cap is doing compared to the mainline indices. So Nifty small cap PE ratio, if you look at, is somewhere around 32. So it is not very high for the small cap kind of level. So it is, see, if you can see, it is at the median level because it typically maintains this kind of a ratio. And if you look at price to book, it is lesser than the mid caps. It is at 3.8 price to book, which is fine. And if you look at the dividend yield, it is somewhere around 0.9. So small cap is not looking that expensive, considering that the growth in small cap is typically higher than the other indices. And if you look at the performance, last 1 year it is given a negative return, so minus 4.6, and last 5 years, look at this performance, it is given a 50% kind of a return every year. It's up to 148% over the last 5 years from the COVID bottom. And if you look at the rolling returns in small cap, last 3 years rolling return has been 24%. And if we look at the last 1 year rolling return, they will be I think they will be close to flat. Yeah, they are close to flat because it hasn't delivered anything much over here. But this is the most interesting chart. If you look at this chart, what it shows is that the small cap index versus Nifty plotting again is been going up steadily. So if you look at it, it kind of bottomed in March 20 at about 0.35. That means small caps are very undervalued compared to Nifty in both the fall. But now look at it peaked at 0.75 and now we are at 0.70. So small caps are also expensive compared to Nifty. However, on a standalone basis, they are probably somewhere, during at their median PE, which is about 30 odd. So where is the value? The value perhaps right now is in large caps, in Nifty. Where is the growth? The growth is in small caps and to a certain extent in mid caps. Now one has to marry the valuations with the growth and see which is the best optimal mix for an individual investor. So if someone is a deep value buyer, they are going to find value more in large caps. But if someone is a high growth momentum investor, then they are perhaps still a small cap might be a better bet for you. And if you are a retail investor and you don't know where to invest, then it is best to invest through mutual funds. And as I have said, that I help people build their mutual fund portfolios in a very robust way, in which we deploy a lot of mixture of strategies. For example, we have momentum and value strategy, we have an alpha strategy, we have a small, mid and large cap strategy, we have an international strategy. So we mix and match all these strategies to ensure that your returns are optimized and your risks are curtailed. And I also help people build their debt portfolios. So if anyone is interested, as I had said, you can find the form, the Google form in the description, and you can fill it and I'll get in touch with you. So that was my take on the markets, whether the markets are overvalued or not. We have seen the last 1 year has been a good correction for the markets, and in my opinion, it's a as good a time as any to invest. If there is further correction in the market, it's going to be even better for you to deploy some capital. That is what I do, and that is what I advise that I give to my clients as well. Don't venture out into small cap names, individual names which you don't understand. Don't venture into companies just basis narratives and stories. For a retail investor, it is very, very difficult to track individual companies, and hence I have been advocating that you should look at investing in mutual fund and indices, because if you do that, the returns are very, very good over the long period of time. If large caps give you 11-12%, mid caps can give you a couple of percentage points higher, and small caps even higher, a couple of percentage points higher than the mid caps. Again, it depends on your entry, where you're entering, what cycle you are entering, and so on, because someone who entered the markets in let's say 2019 would have seen his portfolio really go down in 2020, but someone who would have entered in 2020, you have seen 50% growth for the last 5 years, right? So it also is very important that you buy on dips, and you have a mixture of small, mid, large, momentum, alpha, value, quality kind of indices in your portfolio. So if you're able to do that and navigate, then in the long term you're going to make a lot of money, and the markets will sufficiently reward you for the risk that you're taking, because equity is the best asset class that is available out there, and it is very, very important to be invested in equities, because we all know that the inflation rate worldwide is quite high because of US printing, and the debasement of currencies happen over a period of time. So to protect yourself against that, you have to be invested in solid assets, and equity is one of the best assets. So that's it from me now. If you like my video, please do subscribe to the channel, and please do share it with your friends and family, and do let me know how did you find it. I would love to hear your feedback and how you are approaching this current market, and I shall see you soon with another update. Take care. Bye bye.